Hey traders, this is MsPutOptions and my website is www.msputoptions.com where it can best be accessed through Internet Explorer and not Google Chrome. And today we're going to be talking about a bull put credit spread. And as you can see, I've done a bull put credit spread on this ticker symbol. The ticker symbol is GDXJ. I have 10 contracts here. I have 15 days until expiration. I bought one strike price and I sold the other strike price. I collected 53 cents, which is a credit for one strike price, and then it was a debit for the strike price that I bought of 12 cents. So I have a debit of 12 cents. So if we take the 12 cent and we debit it from the 53 cents, that's going to give me a total of 41 cent. And since I have 10 contracts, as I mentioned here before, I have 10 contracts times 100 shares. That's going to give me a grand total of $410, 15 days from today upon expiration Friday. Now on expiration Friday, I want to take this threat off of the table with this particular option. I want to ensure that I still receive a credit. So what I do is I take the 41 cent credit that I have and I sell this entire option back for 5 cents to take the threat off the table. So if you take the 41 cent and you subtract it by 5 cents, you get 36 cent, and you times that by 10 contracts, and I mentioned over here we have 10 contracts times 100 shares, and we know monthly options are worth 100 shares. That will give me a grand total of $360 in exactly 15 days. So right now, if I were to sell my option back, and we're going to right click and I'm going to show you how to sell your option back, it is saying that I received a credit of 41 cent, but to sell it back today is going to cost me 55 cent. So the difference between 41 cent and 55 cent is 14 cent. And how we derive at this number is we subtract the 55 cent for 41 cent, and that is 14 cent. And if I take this 14 cent, I times it times 10 contracts times 100 shares, this is going to give me a debit of $140. Now the reason why I'm showing you the math here, because a lot of people seem to believe that even though they put up collateral to place this particular trade, that's what's at jeopardy, and it really isn't. What's at jeopardy is the credit that you received. It should never be the collateral that you put out. It should only be the credit that you receive that is at jeopardy if you're monitoring your trades. Now, in order to place this trade, it costs me $4,000. And the way we derive at this number is we take the difference in our strike prices, and our strike prices are 36 and 40, and that difference is 4. We have 10 contracts here, and this is 10 contracts here, and it's worth 100 shares. We know monthly options are worth 100 shares, so it cost me $4,000 to place this particular trade. Now, what you put up for collateral was the $4,000. That should never be at jeopardy. You should always be monitoring your trades. The only thing that should be at jeopardy is the 41 cent credit that you receive for placing this particular trade. And we said if you take 41 cent times 10 contracts times 100 shares, that'll be $410. This should be the only thing at jeopardy. You should not let your trade get to the point where the collateral that you put up to place the trade is at jeopardy. So right now we're going to go to a platform and we're going to look at this particular ticker symbol, GDXJ. We're going to look at the chart of GDXJ. Now, here we are looking at the ticker symbol GDXJ, and this is a ETF. And what I do not like is that this particular ETF at one point over here was trading below the 50-day moving average, which is not a good sign. But as you can see, the line running through this particular chart is called the VWAP line, and this particular ETF is hugging that VWAP line pretty good here. And as you can see, the VWAP line here is in a upward trend. So I'm very hopeful that this particular ETF will go into an upward trend. I have several oval areas marked off here, and this is where my demand is. Several areas here, and then on top here, these are the areas of supply. And as you can see, this oval area is where I am predicting that this particular ETF will go from this area all the way up to where supply is. It will go from this demand area all the way up to where supply is, roughly about the 43.60 area here. here. I'm waiting for some improvement in the volume here. We have 1.3 million right now, but if volume increases, it's more than likely that this ETF will go into a upward position here around, again, the 43.60 area here. What I really like is that this particular ETF with the Williams percent R at one point was at a negative 100, so we had a pullback here, and this is telling me that this particular ETF will probably go in a upward direction after this pullback, which, as you can see, there was a pullback here and it started going in a upward direction. Okay, so again, this is Miss Put Options. My website is www.MsPutOptions.com, where it can best be accessed through Internet Explorer and not Google Chrome.